Why is market structure so crucial in your trading? Without market structure, you are on the wrong side of the market a lot. Simplifying market structure got me from confused and losing a lot to having clarity and a lot of profits. In this video, I'm going to walk you through the most easy and powerful frameworks to use market structure in your trading. To do this, first I'm going to walk you through the 3 ways price can move. After that, with this foundation, I'll help you understand how to identify market structure shifts. And after that, I will share with you how to use market structure on all the different time frames. So let's get into it.
In this episode about market structure, first we're going to talk about what an uptrend is. So when you're moving upwards, how you can spot a downtrend when you're going downwards, how sideways movements look like. And then we're going to talk about a break of structure. So when an uptrend changed in a downtrend or vice versa. And we're going to combine market structure with the previous learned framework about time frames. First, let's go over the basics. Price basically does only 3 things. That's going up in an uptrend, going down in a downtrend, and going sideways, doing nothing. So you will see price going first up, then down and sideways, or then up, sideways, down. There is no specific order when this is going to happen. But now let's look at each of the 3 trends and see how you can spot them and also when they are changing with the market structure shift. First, let's go over an uptrend and how you can spot an uptrend with market structure. How you can spot an uptrend looking at market structure is marking out highs and lows. And if you, for example, here look at this movement upwards, you see based on the candlesticks that we're going upwards, right? But how can you use market structure to put a framework around this? Well, here you see a high, a low, and we're going higher, making a higher high. Then we're making a higher low. Why is this a higher low? Because this low is higher than this low, than the previous low. Then we make another higher high. Why is this a higher high? Because this high is higher than this high. We make a higher low. Why? This low is higher than this low. Make another higher high, higher low, higher high. And we can do this till infinity. Perhaps a question you might ask, for example here, why is the higher low mark at this low and not, for example, at this low? And why this is you need to look at swing lows. And what a swing low is the low in this exact swing, lower to go higher. And how you can identify a swing low is a low with a higher low to the left and a higher low to the right. Then it's a swing low. You see it here as well. You have a low right here with a higher low to the left and a higher low to the right. And the same at the highs. We have a high here with a lower high here and a lower high here. That's a swing high. So with finding an uptrend, you need to mark out your higher highs, your higher lows. Vice versa for a downtrend. You see based on the candlesticks that we're going lower. Let's mark them out with a high. A low, we're going lower. So we're making a lower high. This is a swing high. Why? We have a lower high to the left and a lower high to the right. Swing high. That's why we marked it out here as well. Here's a low. We make a lower low. We make another lower low. Make another lower low. Here, lower high. We make another lower high. This close here, but this is a lower high to the left, lower high to the right. That's why this is a swing high. Another swing high, lower high in a downtrend. So now you know how to spot an uptrend with higher highs, higher lows. Now you know how you can spot a downtrend with lower highs and lower lows. And the third possibility is sideways movement. And marking out highs and lows is quite difficult here. And why? For example, here is a high. Here's a low. Here we make a lower high. So that would indicate we're probably going into a downtrend. So we are seeking a lower low. But we don't have that because here's the last low and we make a higher low. So we have both a lower high and a lower low. Then you make a higher high, but then we make a lower low. So because of this price action, this is low probability and you should avoid this price action. So if you see this in your chart, just avoid trading this. Keep trading a downtrend and an uptrend because in those moves, you can make the most money. If you're an uptrend, you can go long, going up. If you want to go short, do it in a downtrend. Sideways, stay off the charts. Marking out highs and lows is very difficult and just avoid this overall. Then let's talk about a break of structure. So when you're going from an uptrend to a downtrend, how can you spot around this piece of price action that we're probably going from higher highs and higher lows towards lower highs and lower lows? So in a downtrend. Here are 2 pointers you can use to predict this. The first one, wicks go through previous highs and lows. So what you see in this uptrend with clear higher highs, higher lows, higher highs, higher lows. And then right here at this piece of price action, you see this massive wick upwards. Remember from the candlestick video, price starts here with the open. It goes all the way up, but then it goes all the way down, closing right here. So there's lots of sell pressure here. So yes, we took the high here. So we made a higher high. But because of how the body is closing, you can see this as a weakening of the trend because we were moving upwards with the trend, but then huge move downwards. Open, high, low, close. And also you will see higher highs, higher lows, etc. being disrespected. So in an uptrend, you want to see higher highs, higher lows, higher highs, higher lows. But when the trend is weakening, you will see not a higher high being made and a higher low, but now you will see a lower low being made. Then you know, hey, that's very interesting. We're probably going to change the trend right here. So for example, the wick is not very long, but it doesn't take out the high. So you have a higher high, higher low, higher high, higher low. But then this candle fails to take out the high. So it fails to make a new higher high because this swing high, remember, lower high, swing high fails to create a new higher high. We call that failure a failure swing. So this swing high fails to take out this high. So it fails to make a higher high. We call this a failure swing. And after that failure swing, you see that movement downwards and price creates now a lower high. Then it goes to a lower low, lower high, lower low, and it goes downwards. So in this piece of price action is your break of structure. But then it's the question on when is structure broken? And you can choose two areas right here that there's a break of structure. For example, here in uptrend, when the last higher low has been broken. So in this case, it can be this higher low or this higher low. So you see this massive move downwards and you know, okay, in this piece of price action, I can go look for shorts instead of longs because we broke structure. And if you want to annotate everything, higher highs, higher lows, everything, break of structure, failure swings, it will look like this. Higher highs, higher lows, uptrend, then it makes a lower high, a failure swing, higher low. I like to mark out when this higher low has been broken at this break of structure, but you can also use this candle as your break of structure. That's up to trader discretion. So look for the last higher low to be broken. And then you know, okay, we're probably going down for a while until these lower highs, lower lows are not respected anymore. And we start making higher highs and higher lows again, like we did here. We're going back in an uptrend. So now you know how to spot an uptrend, how you can spot a downtrend, when there's sideways movement, and also when there's a break of structure. Then it's very important to combine the lessons from the previous episodes. So you know what a candlestick are, you know what pairs are, but you also know what time frames are. And the main rule for market structure is, and how you can trade that, is the trend is your friend. So high probability trades is when you have the three buckets. So higher time frame, intermediate term time frame, and lower time frame. If every market structure aligns, so for example, on all the three time frames, we going up. That's very nice. You can trade that. But what if on the daily we go up, on a 1 hour we go down, and on a 5 minute we go sideways? That is possible. Then you know, okay, maybe I should wait before the trend is aligning itself again with all the three time frames. Remember the rule of 3? You need to keep applying that to your trading. Now let's dive to TradingView to see some examples. Currently, you're looking at the euro US dollar on the daily. We're looking at a live chart. So we're now at July 2024. And here on the daily, we were here in an uptrend, higher highs, higher lows. But then right here, we had a higher low, but then it made a lower high, then a lower low, then a lower high, then a lower low. And then right here at the current price action, we had some consolidation, some sideways movement. But you saw here, we made a lower low, then a higher low with higher highs. So now recently on the daily, we are back at an uptrend. So we marked it out with an uptrend. And now let's look at the 1 hour and 5 minutes. So 2 time frames from the other 2 buckets to see if the trend and our market structure aligns with all the 3 time frames. So here we are at the 1 hour and you see we're making a higher low, higher high, higher low, higher high, and so forth. So here you can see we are currently also in an uptrend on the 1 hour. And now let's dive into the 5 minute to see if we also have an uptrend. So we know, okay, we can safely, with the trend, with our structure, place long positions in the market. And now we are at the 5 minute time frame. So again, at the 5 minute time frame, every single candle is 5 minutes. So now you see we have some sell off here, but then here we made a lower low, but then a higher low, higher high, and so forth. So now we are also in an uptrend. So in this piece of price action, it's currently, the time is here 2:20 New York. So that is the London morning. At this time, the London Stock Exchange goes open. Remember from the pair video is you need to trade when the stock exchange are opening. So the London Stock Exchange opened in this price action. And you see we had some sells here, but then we had that bullish engulfing candle. The candles fail here to go lower. See that bullish engulfing candle upwards, making higher highs, higher lows. So, you know, in this price action, you could have taken a long position. And that long position on the 5 minute is completely in line with your other 2 buckets, with the 1 hour in this case, and also with the daily. So these long positions are very nice to take. And here we are at the euro US dollar at the 1 minute chart. We see exactly the same price action as we saw just now on the 5 minute. But there's one important note you should remember here. The lower the time frame, the more break of structures you will see. So for example, in this piece of price action, this is midnight here, we have a few hours of price action here. And in those few hours, we've seen a downtrend, we've seen an uptrend, we have seen some sideways movement. And most new traders go to the chart immediately to the 1 minute because more candles are printed, there's more price action, and they're just completely lost on the chart because they're like, oh yeah, I'm going to take a short here, we're going lower and lower and lower. And then they get stopped out by this movement upwards because they don't trade with a higher time frame trend in mind. So always start at the higher time frame, your higher time frame bucket, daily, weekly, monthly. For intraday traders, just do daily. That's fine. Is the daily going up? Then look if your intermediate term and short-term time frame are aligning with that upwards momentum. It is very hard to short a move on a lower time frame when on a daily, weekly, monthly we're going up. Yes, you can make money, but the highest probability trades, so the trades where it's most likely that you're going to make money, are with the trend. Thank you for watching this video. In this video, we went over the basics of market structure. By now, you know what an uptrend is, what a downtrend is, how you can spot sideways movement, and with those trends, how you can identify higher highs, higher lows, lower highs. You also know what a failure swing is. You also know what a swing high and a swing low is. And on top of that, you also can identify a failure swing. So when it's most likely that the trend is going to be weakening. Together with the 3 different types of structure, up, down, and sideways, you also know when a break of structure happens and how you can use that market structure together with the market structure shift, so the break of structure, how you can combine that with the time frame alignments from the previous episode. If you like this kind of videos, please like and subscribe, share it with all your trading friends, and I'll see you in the next one.